Folks, we have one of the most interesting markets I've seen in some time. This is a market of the haves and have-nots. And what I'm going to take you through here is a ton of stocks that are absolutely crashing here today, once again. And then I'm going to take you through some stocks that are not crashing here today. And what you're going to see is there are certain groups of stocks that are doing really well in this market, and they really have those shareholder bases, and other groups that just don't have it, to be completely honest. And then I'm even going to share one stock with you guys that's absolutely going beast mode here today, in a day when a lot of stocks are getting devastated. I hope you guys enjoy this. As always, thanks for joining me. Alrighty, so first off here, Zoom stock. Still trying to find the bottom. Zoom stock is. I mean, look at this stock. It's down from $400 plus a share back in August. I mean, that was what, 6 months ago or so? And here that stock is down another 7% here today. $112. And a lot of folks are looking at this, hits another 52-week low, and it's like, where is the bottom for Zoom stock? And I think that's a fair question. It's like, where's the bottom for this stock? It can't find a bottom anywhere in sight. Every time you think maybe it finds a bottom, it just doesn't find a bottom. It just continues down more and more and more and more. And so when I look at a stock like Zoom, I see a stock, right, that got so much hype behind it and so much excitement in the business model because of Rona, right? Everybody being forced to be at home. Now you see Google's about to open back up their offices in April. You hear a bunch of the other big tech companies are opening up their offices. Ton of corporations in general are opening up their offices. Life's getting back to normal for real this spring. Like for real. The masks are all going away across the board. And so with everything returned to normal, a stock like Zoom is just kind of in no man's land. And the thing with Zoom is, like, people are still going to use Zoom even when offices open back up, right? But you've taken away all excitement away from this stock. All excitement has been completely taken away from Zoom. And so now all it has to go off of is like PE ratios, right? And the tough thing with PE ratios is, with how much competition they have coming after them, and the fact that their core product is by far and away their entire business, essentially, as of right now, at least, until they get something else that's like, wow, this is a huge other business outside of just the video communication platform, right? They're going to have to just be judged on financial metrics, and there's no excitement there, right? And so that's why a stock like this literally just can't find a bottom right now, because people are like, do I have to buy it? It's still at a 25 P, and the forward P is probably even more than that. Do I really have to buy it here today? And so that's a tough thing for a stock like Zoom. Now, look at Block Square. So this one was coming back, but here today it had a big downward move, about 7%. Now, one thing I want to say about Square, this stock's a buy. Okay, this stock is a buy. I don't personally own it, but I will say, this stock at $100, or especially, at these low hundreds, or even if it goes under 100, it's a buy for anybody that's a long-term shareholder, like long-term focus next 3-5 years. They own the Flip and Flapjack and number one financial related app in all the developed world, like in Cash App. That's probably, in my opinion, it could be worth, $100 billion plus just in itself. I'm not even talking about Square's traditional business. I'm not even talking about all the stuff Square's doing with blockchain technology, all the stuff they're doing in the crypto space. I'm not even talking about any of that. Just Cash App alone will be an app that will as a standalone would be worth $100+ billion in my opinion. And so this is one of those stocks that, although that's exciting, it's still, it's having some struggles out there. On a day like today, when a lot of these stocks get hammered, it's down 7.77%. That should be a sign I should buy it, because it's 777. It's a level of the sevens. My main house is in Vegas. So PayPal also downward move. This one's an easier buy than Square because the valuation is so dang low, and you can actually throw Ps and forward Ps on it that are extremely attractive for this company. Much more well established, and they're more diversified than Square. That's the great part. They own the number 2 and number 3 apps that are usually most popular in the financial category in developed world. That is PayPal, and that is Venmo. Okay, and so PayPal, they're in a really good spot. Their stock is not in a good spot though. That's the thing. This is another one of those stocks that it's like, where's the bottom? I think we're really dang close to the bottom on PayPal. I think it can be shaky here, but I think we're getting real darn close. And the reason I think that is just you're when you start getting PayPal down to a 28 P ratio, maybe under a 25 forward P ratio, it just starts to get really, really silly for a company like this that has a business model like this and the type of growth this company has. I think they need, their next quarter can't come fast enough. Let's just put it that way. When it comes to a company like PayPal, you look at Shopify. This is another one of those stocks that benefited huge from everybody being at home, right? and people setting up online businesses and things like that. Stock was peaked out about $1,700 in November. And you're also going to notice something interesting. Most of these stocks we're going through here either peaked out in November or peaked out in the summertime. Now, unlike a lot of the meme stocks and the retail trader crowd stocks, those ones actually peaked in January, February of last year. And those ones were the first ones to start dropping off a cliff, essentially. A lot of these more well-established companies, bigger market cap companies, a lot of them either peaked late in the summertime or actually in the November timeframe. Shopify is one of those companies. Now, Shopify's got a great business. They got a beast business model. They're going to be a huge company over the next 5-10 years. And I look at this company and I see it being one of those that has, if you're thinking about like who could be $1 trillion plus company, 10 years from now, who's got that type of opportunity? I think Shopify is one of those companies that has that sort of opportunity in front of it. And there aren't a lot of companies you could really truly say that about, right? Or at least, several $100 billion opportunity in front of themselves. But when it comes to Shopify, where's excitement for the stock right now? There's no excitement for Shopify right now because there's such a pull forward in demand. The amount of new customers they'll have coming on is going to be, much smaller than they had the last 2 years. And so what does Shopify have to go off of right now? Financial metrics. And no one wants to, pay the financial metrics that Shopify really has. Their PE ratio is messed up. Look at their forward PE. It's 100 plus. Look at their price to sales ratio. It's insanely high. And so even though their stock has dropped so much, there's just no excitement in Shopify right now. And the market's not really looking at it from a long-term investor perspective right now. The market is really focused on this next 3 to 6 months. That's all most of Wall Street cares about right now, the next 3 to 6 months, okay? The next 3 to 6 years, it doesn't matter for the market right now. And in this sort of market, a stock like Shopify that you have to be, if you're buying Shopify, you really have to be playing it from a multi-year perspective. And if you're not playing it from that multi-year perspective, then it's just a situation where, no one's there to buy the stock. And that's why it just continues to just go down and down and down and having such trouble trying to find a bottom anywhere. It just hits new 52-week low after new 52-week low. Roku, another one of those stocks that peaked out in late summertime, July 23rd. This is stock's, approaching $500 a share. And another one that benefited from everybody being at home, and it just continues to hit new low after new low after new low down to a $17 billion market cap on this one now. Roku, I've never seen it with Roku, so I don't want to speak down on the company. I've just never seen it. It's just never been my cup of tea. I don't really have anything good to say about Roku. Now, when I think about all those stocks being down, I think about Ark, right? And Ark, tough day for Ark here today, down over 7%. Ark is. Ark was at 124, which is a double up from here on November 3rd. That's like 4 months ago or so. Just vicious. Just vicious that this stock has fallen that much, that fast. Well, it's not a stock, it's an ETF. It's one thing if it's a stock and it falls 50% that fast. It's another if it's an ETF. And so Ark's just completely dependent upon what Tesla stock does, what Teladoc stock does, what Roku stock does, what Zoom stock does, and those ones just have a lot of trouble. And something I pointed out, Ark's biggest holding is Tesla, right? And I'm a Tesla shareholder, and I was a believer in that company and investor in that company way before everybody jumped on the bandwagon, right? And what I said in regards to Tesla over the past year is I said that stock could easily have a 1 to 2 year chill out period. And guess what? That's exactly what it's doing. It's having its 1 to 2 year chill out period right now. The stock's gone nowhere. You look at that stock, it was like a $900-something stock back in, January 2021. Here today, it's under that price. It's going through just a chill out period for Tesla where it's going to go up, down. They're going to report sick numbers, but just because they report sick numbers doesn't mean the stock price is moving up in the short term. And that's the thing I try to bring out to a lot of people. And they're like, well, but the numbers are numbers. It's not the way it works. If you already priced in a lot of that growth, then your stock is due for a chill out period. We've seen the same exact thing in Amazon stock, right? Where it's gone through almost a 1 to 2 year kind of chill out period. Now, I do think stocks like that are going to be ready for a big boom, probably starting in a few months from now, specifically a little more toward Amazon. But for right now, those stocks are just still in their chill out period. And for, something like Ark, when they got countless of their stocks just crashing through the floor and hit new all-time lows and new 52-week lows, and then you have Tesla in a chill out period right now, what does Ark have going for it? Until things flip, it's just in a really, really, really tough spot. Palantir, tough day for Palantir, 6.6% down. Palantir here today. This stock was $26 back in November. Just another one that's been absolutely devastated. I will say Palantir is looking like a snack. If the stock remains at $11 or under, after my last few small caps report, I'm going to be buying some Palantir. And when I say buying, I mean like real deal Holyfield buying, like 50K, 100K type buys, big buys, okay? So this one's looking like a snack. I'm kind of hoping it stays down for here a bit because I actually really like that one. Snowflake, massive downward move for Snowflake here today, 17.5%. So here's the thing with Snowflake. Their numbers are sick, okay? I mean, absolutely sick. But their valuation was also sick, okay? And so this stock is being basically almost cut in half since November 16th, right? So 4 months ago or whatever. And it's a company that's executing on all cylinders. You look at their numbers and you're like, this is amazing. Their revenue growth, their customer retention, everything. Like I can't look at anything bad in Snowflake. Like I looked at those numbers and I was like, oh my gosh, okay, this is nice. This is nice. Obviously negative EPS, but outside of that, I mean, everything is just clicking on all cylinders, and it's gonna, this is gonna flip from a money loser to a massive money maker, and pretty darn quick too. But when you're a stock like Snowflake and your valuation got pushed to the moon, literally, right? I know they like to use the expression to the moon. This valuation got pushed to the moon. I tell to folks all the time, if you price in so much of that growth, even if you come with those insane numbers, your stock's not going anywhere. It's actually probably going down even if you come in with insane numbers, unless you come in with such insane numbers that it even kills every single bullish analyst on Wall Street. And so that's what happens with these stocks time and time again. And so they have to end up downtrending, and they go through some vicious down cycles, and people get frustrated because they're like, man, the numbers are so great. The numbers are so great. Did they not see they posted 100% revenue growth, ... It's like, dude, if the valuation got pushed up that much, that's why in the stock market, it's not just important about picking the right companies in terms of business models. It's also important about the valuation and where that company's net income is going over the next 5 years. That's very, very vital in this game. For Snowflake, they need to get their net income to $3 billion plus over the next 5 years. I think they're going to get there, but that's what they need to do, right? And right now in this sort of market, once again, we're not in a market that people are really looking at a 5-year basis. They're looking at the next 5 months. That's all people care about right now. The next 3 to 6 months, next 3 to 6 years doesn't matter in this sort of market. And for a stock like Snowflake, that's not a ideal market for these sort of stocks, right? Docusign, another one of these stocks that was obviously everybody's at home, everybody's doing business from home. The e-signing of documents business got a huge pull forward because of Rona. Now, the bad thing, there's good and bad, okay? The good is there's a ton of people that are e-signing documents, and a lot of those folks aren't going back to physically signing stuff, okay? So that's great for Docusign. Very, very good, and that's the way the world's going. Everything will be e-signed in the future, in my opinion. Physically actually having to sign stuff, that will go away pretty darn quick, in my opinion. I think if you're still physically signing stuff 5 years from now, I'll be amazed. That's all I'll say about that. And more and more stuff, if you have to sign a lot of documents, you're seeing more and more stuff be DocuSign. Just imagine in 5 years. And so DocuSign's got the premier name and brand in that space, but they also had the hype. And now with everybody getting back to normal, they don't have the hype anymore. There's no hype in DocuSign anymore. And so now, once again, you just have to go to valuing that based upon valuation metrics. And that's a tough thing for DocuSign to put up. If you look at their price to sales ratio, their forward P, anything like that, it's like, do I really have to buy DocuSign? So this is a tough thing for companies like DocuSign. If this stock continues to fall, I wouldn't be surprised at all if somebody tries to buy out DocuSign, a big tech company. Think Microsoft. I would not be surprised at all if Microsoft didn't try to make a move there. It seems like it's right up Microsoft's alley, right? Think about Microsoft loves all businesses to use Microsoft. Think about their suite of products. I could see potentially a fit there. Microsoft's not afraid to do big deals. Remember, Microsoft bought out LinkedIn. So we'll see what happens with DocuSign stock price. But if this baby keeps falling, believe me, there's going to be a lot of big tech companies that are going to be pursuing them, trying to do a deal, because it's a very nice tuck-in acquisition. Very, very nice. So that's kind of my 2 cents on DocuSign. Now, meanwhile, those stocks doing that. But Yet a lot of these small caps are holding up very, very nicely. The Chef is down today, but it's not down like these other stocks are down, right? And it's actually up in the past 1 month. That's pretty darn intriguing, right? Corsair Gaming today is up. The stock is up. Look at the past 1 month from $18 to $23, right? Interesting. I mean, look at the divergence in the small caps versus a lot of these large caps that had the hype. The Planet's break even today. Interesting. Honest is down, but it's hardly down today, 0.85%. And so, we're going through all those big companies that had all the hype that are seeing their stock prices go down 5, 7, 9%, 17%, whatever, right? And meanwhile, you have a lot of these small caps holding up very, very nicely. And, what I think is going on is I think we're getting a rotation of money to some of these small caps. Also, I think these smaller cap companies, I think their shareholder bases are built different. Okay, I think they're built different. I think these, these shareholder bases are just saying, we're here, we're not selling, and if anything, we're buying. And Wall Street's not playing these sorts of stocks, right? So if Wall Street wants to sell off the market 10%, these stocks are not even going down, and actually some of them are going up in this market, right? Which is just like mind blowing to people because usually the type of stocks you'd expect to be down more. But these stocks already went through kind of their devastation cycle, let's call it that. And now their shareholder bases are just holding strong. And if anything, they're buying. And that's exactly the way I look at those stocks, right? It's like, if anything, I'm buying those stocks, right? I've got something like Tattoo Chef. I have some money in reserve just in case they drop in any significant way with earnings. Just in case. It's there and it's ready to be deployed directly into that stock if it was to fall in any major way. And so that's kind of the way I think about it, right? I think that's the way a lot of shareholders think about it. Honest has the best risk reward in the entire stock market, in my opinion, over the next 3 years, and by quite a bit. And so these sorts of shareholder bases, they're just holding strong. And at the end of the day, they see their stocks go down. They're buying. And they're not worried about what Wall Street's doing and what Wall Street's not doing. It's a very interesting market to kind of see this happening, right? Look at Avant Brands here today, up 3% in this sort of market is surprising. Now, the weaker shareholder bases, right? The retail crowd that just got in the market in, let's call it 2021, the very end of 2020, the very beginning of 2021. A lot of those folks, just were looking at the stock market from like a gambling perspective, and whatever was the hype stock at that time, they're just buying it, right? Think about stocks like Wish that has a very questionable business model. Think about Clove down almost 12% here today. Fubo, I actually think Fubo is actually an attractive buy at $7. That one's down almost 11% here today. This one down 6.3%. Skills down about 10%. Those sorts of companies are just, they're having a lot of trouble because their shareholder bases aren't built different. Those shareholder bases aren't strong. People can't look at those business models with conviction because some of these business models are actually in decline. And there's no sight to profitability anytime soon for a lot of these business models. And so those ones just, they don't have that sort of shareholder base there to get their back. They're just not there. There's not like it's not like a TTCF shareholder base where it's like, we understand this company has a decade of growth in front of it, right? And, if we see the stock go down, we're there to buy it. These shareholder bases, they just don't have it like that. Because who wants to buy Wish stock? You know what I mean? Unless the new CEO pulls off a miracle there, they're going to need a lot of wishes. Let's just call it that. That business model is trash, like straight trash. And a lot of these companies just got huge valuations on it and got very weak shareholder bases. And a lot of people just don't buy the dip in those stocks because they're looking at it and they're like, why should I? These business models don't really have it. They were just hype and excitement. And they went public kind of at the perfect time to capitalize on that. But those days are long gone. And so now you got to actually prove that you have a legit business model that's going to be around over the next decade. And that's a whole different game than playing the game of, hype and hysteria that we were in, over a year ago. It started to end a little over a year ago, about a year and a month ago. January was really the final ascension of these sorts of companies. Right now, they just don't have it like that, right? Meanwhile, you look at a stock like Kroger. It doesn't get simpler than this. It's the biggest grocery store chain in the United States of America, right? It doesn't get simpler than this. Look at Kroger here today. 11% plus upward move. Look at the stock over the past year. I would say the far majority of stocks, I would put an estimation of 90% plus of stocks are lower today than they were March 3rd of 2021, okay? I would say that. And I would say if you're talking about mids and smalls, I'd say like 98%. And you look at Kroger, $33 back a year ago. It's $54 here today. This one's just absolutely being a beast. And, the numbers are very, very strong out of Kroger, which grocery is showing a lot of strength right now, which bodes very well for Tattooed Chef. Target reported double-digit growth in grocery category. That's phenomenal. Kroger has some amazing numbers in grocery. So I'm actually looking at a lot of this with, thinking about the chef, and I'm like, okay, this is phenomenal. I love to see this. Target's obviously looks like the chef's biggest customer by far, but Kroger, I can see them expanding massively with Kroger over the next 6 to 12 months, obviously over the next multi-years, but just specifically over the next 6 to 12 months, I think they're going to have a lot of new products that hit Kroger. We've already seen pictures of basically an unannounced products of burrito products that are going to be sold at Kroger. And it looks like they're probably going to do that deal first with Kroger. Those images have leaked out of Kroger's website. Actually, Tattoo Chef hasn't even officially announced it yet. It's kind of hilarious. But yeah, a stock like that, simplest one, just a gigantic grocery store chain. And look at, making a ton of money. But this isn't the sort of stock that's hyped, right? It's not Zoom. It's not, Shopify or Roku or any of those stocks or any of the Ark stocks, right? This is just a solid, great company that just executes. And it's the biggest grocery store chain. And there they are. Their stock price is doing great, right? In this sort of market, it's pretty fascinating. So, by the way, if you want to sign up for Hungry Bowl email daily newsletter, go ahead and check out pinned comment down there. We send it to you. That's Graham and my company, essentially. And, we have writers that write up essentially basically all the news you need to keep up with in regards to the business community, stock market community, crypto community each day, all the biggest stuff out there. It's free to sign up for that. So I hope you enjoy that. It'll be pinned comment down there. But in this sort of market, we're in the haves and have-nots. You have certain shareholder bases that just hold mightily strong in this sort of market that's in a face of the wall of worry and are just willing to buy the dip and continue to buy the dip and build ownership positions bigger and bigger in these stocks. And you got these other shareholder bases that they just don't have it like that. And that's going to be the way it remains. And the companies that are going to thrive are going to be the ones that put up that solid revenue growth year after year and get closer and closer to profitability. If they're not profitable, and if they're already profitable, just continue to get more and more profitable year after year after year while posting those great revenue numbers. And those will be the stocks that thrive. And the hype's done in this market. It's 100% done. It like I said, it left in a lot of that retail crowd starting in January, February of last year. But now there's no hype in this market anywhere in the market anymore. Nowhere. There's 0% hype, which I actually like because that means we're actually in a healthy market now where you're going to be judged on your future revenue growth, where you're going to be judged on your current revenue growth, where you're going to be judged on your current profitability, where you're going to be judged on your future margins and your future profitability. That's a healthy stock market to me. That is something I appreciate. Much love as always, and have a great day.